Welcome to the Economist in Your Ear podcast. Have you ever stopped to think if the way we measure financial risk, that whole foundation of investment theory, what if it's not quite right? What if markets aren't driven by complex math, but by something, well, much more basic, like fear? Today, we're digging into a really fascinating challenge to financial orthodoxy, sparked by a recent Economist article. It puts forward this idea that it's not risk in the traditional sense, but actually two specific fears driving asset prices. We'll unpack this, see where it really hits the mark, but also take a critical look at where the framing might maybe go a bit too far. We've got some extra analysis to help us with that. So let's start with that core belief. More risk equals more return. Standard portfolio theory, right? It usually defines risk as variance spread of possible outcomes. You picture that neat bell curve. It looks elegant. It works mathematically. It's what everyone learns. But does the actual data back it up consistently?
Well, that's where it gets interesting. The Economist piece, leaning on this new research by Arnott and Macquarie, points out some, let's say, significant cracks. First off, stock returns. They don't neatly follow a bell curve. You get more extreme results than you would expect, and it's not symmetrical. And crucially, investors don't seem to fear the whole spread equally. It's the downside, isn't it? The potential for actual losses. That's what really bites.
That makes intuitive sense. We worry more about losing 100 pounds than we get excited about gaining 100 pounds.
Exactly. And then there's the whole equity risk premium concept, the idea that stocks have to outperform bonds over the long haul because they're riskier. The Arnold and Macquarie paper really challenges this, using U.S. data going way back to 1793. Get this, if you invested in stocks in 1804, it took you 97 years just to catch up with bonds.
97 years, wow.
Yeah, and then by 1933, you were behind again. So over that whole massive time span, the statistical link between variance, that classic risk measure, and the returns you actually got was pretty weak, surprisingly modest.
Okay, but you hear the counter-argument, right? The U.S. market has been exceptional, a real historical winner. Maybe it's just a U.S. story.
That's a really good point to raise. And if we look bigger picture, you're right to question it. While the overall U.S. equity premium up to 2023 looks huge, something like 70% of that gain came from just one specific, pretty amazing period, 1950 to 1999.
Ah, the post-war boom years.
Precisely. Outside that window, U.S. stock performance relative to bonds, kind of average, sometimes even poor. And if you look globally, other researchers, Dimson, Marsh, Staunton, also Chambers, and others, they've shown plenty of markets where bonds actually beat equities for decades. So this idea of a simple mechanical rule, take more risk, get more return, it starts to look a bit shaky globally too.
Right, so the traditional picture has issues. This is where Arnott and Macquarie step in with their alternative idea. They're saying forget variance, think about two fears, fear of loss, FOL, and fear of missing out, FOMO. Can you break those down for us? What are they, and how do they supposedly explain things differently?
Yeah, this is the core of their argument. FOL, fear of loss, is basically tied to that downside risk we talked about. Mathematically, it's linked to something called semivariance. Instead of looking at all deviations from the average return, it only looks at the negative ones, the returns below average or below zero. It directly captures that gut feeling, that fear of your investment actually losing value.
Okay, that makes sense. So what about FOMO, fear of missing out?
FOMO is about the other side of the coin, an asset's potential for, well, really big unexpected gains. It's related to what finance people call skewness. Positive skewness means there's a small chance of a massive payoff, like a lottery ticket, even if the average return is low or even negative.
Ah, like meme stocks or maybe in cryptos.
Exactly that kind of thing. This FOMO helps explain why investors might knowingly overpay for assets with these lottery-like characteristics. They're chasing that slim chance of hitting the jackpot, even if traditional models say it's a bad bet based on average returns. And there's actually, a pretty solid body of existing research documenting this demand for skewness or lottery-type assets.
So it's bringing the emotional, the behavioral side much more into the foreground, less cold math, more human psychology, and it certainly feels like it explains some of the wilder market behavior we see sometimes.
Precisely. It lines up quite neatly, actually. If you think of fear of loss as downside risk preference and fear of missing out as a preference for positive skewness, it connects well with known market anomalies, things that standard models find hard to explain. It gives us a behavioral angle on why some assets get chased, why bubbles might form, even when the standard risk-return numbers don't seem to add up.
Okay, the Economist article frames this full FOMO idea as potentially a new paradigm for thinking about asset prices. But digging a bit deeper, how truly new are these underlying concepts? Or is it more of a repackaging?
That's a really critical question. The fear language is definitely powerful. It's very intuitive. But the core ideas behind it, they have a history, tying fear of loss to downside variance or semi-variance that goes back to Harry Markowitz himself in 1959. He won a Nobel Prize for portfolio theory.
Right, the father of modern portfolio theory.
Exactly. And the preference for skewness, the FOMO aspect, that's been kicking around in asset pricing models since the 70s with Krauss and Lichtenberger, and then folks like Harvey and Sadiq explored it more in the 2000s. So Arnett and Macquarie, I think it's fair to say, are doing a brilliant job of synthesizing and framing these established ideas around downside risk and skew preference. It's a very effective repackaging, a great synthesis, but maybe not a complete from-scratch discovery of fear itself in markets. The claim is more synthesis than revolution, perhaps.
And what about relying so heavily on historical data to make the case? You mentioned the long U.S. history back to 1793. How robust is that for proving a future pricing model?
Yeah, that's always the challenge, isn't it? Using ex post history, what already happened to define ex ante pricing rules for the future is, well, tricky.
Ex post versus ex ante. Looking back versus looking forward.
Right. Just because you find a weak link between historical variance and historical returns doesn't automatically prove investors don't care about risk when they make decisions today. It might just mean that variance, measured after the fact, is a noisy, imperfect proxy for the risk people were actually perceiving at the time. Market conditions change, right? And importantly, there are other sophisticated models out there already, things like habit formation models.
Where our past consumption levels affect our current risk appetite.
Exactly. Or rare disaster models, which focus on the fear of those huge, infrequent crashes. These models already explain why risk premiums might change over time, linking them to things like consumption fear or tail risk, without throwing out the concept of risk altogether. So for FOL and FOMO to be a true paradigm shift, they'd really need to outperform these established models in proper out-of-sample tests, predicting the future, not just explaining the past.
Okay, prediction is key. So if fear is the driver, how do we actually measure FOL and FOMO in a way that's useful for investing now? It feels a bit abstract.
Measurement is absolutely crucial, you're right. For this framework to be practically useful, you need reliable ex-ante measures. That means forward-looking estimates of downside risk, forward-looking estimates of skewness, and maybe even some way to track how investor preferences for these things change over time.
So not just looking backwards.
No. Without those forward-looking metrics, there's a danger that FOL and FOMO just end up being fancy new labels for factors we already know about in other models. Things like downside beta, how much a stock tends to fall when the market tanks, or cost skewness, which relates an asset skewness to the market skewness. You'd need a rigorous horse race comparing fall FOMO directly against these existing factors using transparent data. And you have to be really careful with old data, like that 19th century U.S. stuff, issues like thin trading, survivorship bias.
Yeah.
They matter.
Makes sense. So practical implications. If this fear framework holds water, does it mean we tear up our old investment playbooks, change how we allocate assets?
Not necessarily tear them up. No. Look, even if current markets are, say, heavily influenced by FOMO, may be leading to low expected returns for equities right now. That doesn't mean risk pricing is dead. It might just mean the price of risk is temporarily low, or that investors are currently overpaying for lottery tickets for that skewness. Any fear model to actually guide your investment decisions would still need a disciplined, forward-looking way to measure these fears and translate them into portfolio weights. It's more about potentially refining our understanding of risk, not abandoning the concept.
Okay, so wrapping this up, what's the bottom line for someone listening, trying to make sense of markets? The Economist article definitely highlights something important. Fear clearly plays a big role. But it sounds like the claim of a new paradigm needs more testing.
I think that's fair. The real work is arguably still ahead. What's needed is a proper research program. That means building tradable investment factors based on these ideas, one capturing downside risk, or FOL, another capturing skew preference, or FOMO. Then, you need that rigorous horse race across different markets, different assets, stocks, globally, bonds, credit, currencies, commodities. And critically, you need to publish the out-of-sample results. Show that it works going forward, that it has predictive power beyond just fitting historical data. That's the real test.
And just thinking practically, are there any broad takeaways for listeners managing their own finances, even if we're not giving specific advice?
Absolutely. A few things come to mind. First, maybe be a bit cautious about portfolios heavily loaded with those lottery-like stocks, the ones with super high recent returns or extreme speculative appeal, often called high max stocks. The long-term evidence suggests they tend to underperform, despite the occasional huge winner.
So resist the hype a bit.
Perhaps. Second,
If you genuinely want exposure to that potential big upside, that positive skew, maybe consider using options markets to buy skewness directly. It could be a more targeted, maybe even cheaper way than just buying overpriced stocks hoping they're the next lottery winner. And finally, think about managing your downside risk actively. Don't just rely on diversification or hope variance disappears. Consider explicit strategies, maybe hedges or ensuring your cash flows match your needs to protect against significant losses. Actively prepare for the downside.
So it's a compelling idea, this fear framework. It feels intuitive, and it's a powerful synthesis of existing behavioral concepts. But its claim to being truly revolutionary really depends on that future out-of-sample proof, showing it genuinely outperforms current models in practice. It definitely pushes us, though, to think harder about the psychology, the human element behind market moves, beyond just the standard deviation numbers. It leaves you wondering, doesn't it? What biases might you bring to your financial thinking? Is it more the fear of loss holding you back, or that nagging fear of missing out pushing you forward? How could understanding that change your approach?
Thanks for listening. Follow us to stay updated with the latest insights on The Economist every day. And don't forget to like, comment, and share.